Welcome to online lectures by CA Studies. For more lectures online, please do visit castudies.lk.
Hi guys, welcome back. So we have studied what is sole proprietorship and partnership. So today we are going to learn about companies. According to Sri Lankan legal system, any organization which is registered under number 7 of 2007 Companies Act is called companies, right? Any organization can be registered under Companies Act, right? There are application there according to ROC rule, registrars of companies rule. There are criteria who can be registered as the companies, right? According to that, if any company is registered, any organization registered, that is called company. According to Companies Act, I think section 6 of Companies Act, companies can be divided into two. First one is limited liability companies. Second one is unlimited liability companies. Limited liability company also divided into three. Private limited companies, public limited companies, companies limited by guarantee. Now I am going to explain all these four companies. Actually, I have to write the full name here. That is private limited company or companies. Public limited companies. Here companies limited by guarantee. Because all of us are used to write in short form, we are writing. But in exam, definitely Chartered Institute also. Not only Chartered Institute, any exam, students are expected to write a full form of anything, right? According to Companies Act, there are two types of companies. Main types of companies are limited liability and unlimited liability companies. According to section 6 of the Companies Act, limited liability company can be divided into three: private limited companies, public limited companies, and companies limited by guarantee. Public limited companies also divided into two. First one is quoted company. It can be called listed company or unquoted company. Limited liability company means, right, I am coming from the first type. Limited liability companies means shareholders' liability on the company's debt is limited up to their investment. For example, say shareholder A invested 100,000 to company. Say company name is ABC. Shareholder B also invested 50,000 to companies. So company B is the capital 100,000 plus 50,000, total 150,000. say company is running more than 1 year or many years, so after one time at the date of one particular date, company's capital will be same amount. If no any investment in this company's shares or no any infusion by the shareholders, there will be same capital amount. But company's profits, company's assets, company's liability can be changed. For example, say with this capital, when capital invested, capital will be increased and cash also increase. Right? When cash increases, right, company will use this cash to buy the inventory. Then when company buys the inventory using this cash, inventory will increase, right? Inventory will increase by say 150k. Cash will reduce by 150k. Right? Then this inventory purchase through this cash. Cash now reduced. Say sales. This inventory will be then sell to customer. Say then customer is credit customer. So debtor will increase by 200k. So inventory will reduce by 150k, debtor will increase by 200k. So that 50k is profit, net profit. So this 200,000 should be in cash, but it is in a debtor. So there is no cash available. For example, again company wants to buy inventory, right? Because inventory is now finished. So if company go to buy inventory, company does not have the money now. Money is zero. Money is zero now. Inventory also zero. Profit is 50k. Capital is under 50k. Debtor is 200k. So company wants to buy more inventory in order to do the business. So company sometimes requires the money from the shareholders. Shareholder will invest to the capital. Sometimes shareholder will say go for credit purchase. So if we go for the credit purchase, creditors will increase. Say again we are going to buy 250k credit purchase. Credit terms for this purchase may be 30 days. So after 30 days, definitely company wants to settle this 250,000 creditors. Then inventory will increase again by 250,000. So inventory balance is 250,000. Now assume, this is assumption, assume in Sri Lanka coronavirus has been increased as much as possible. Then no one can do the business. All lockdown, curfew imposed, government does not allow anyone to go out. So this business will be stopped. Right? But who will suffer from this business now? Creditors given the 250,000 worth of goods without taking the cash. At this point, company also do not have the cash. Right? At this point, right? Say this company is closed. Company is closed. Creditor should be paid by the company, not by the shareholder. Shareholder already given a company 150k. Closed. If company is closed, creditor will lose the 250,000 of worth of cash. Shareholder will use the 150k of capital. What they invested not being recovered. They recovered only 50,000 net profit. This net profit also not in a cash. Right? Here cash is zero. So no one can be paid back. Therefore at this point shareholders cannot be asked by any creditors or any lenders, any loan provider to give back their money. This is called companies limited liability companies, right? According to Companies Act, private limited companies, public limited companies, example can be this, right? Third one is companies limited by guarantee. I am still in the topic of limited liability company. So limited liability company example is this. So it can be applied to private limited companies and public limited companies. But companies limited by guarantee mean shareholders are agreed to some amount. Shareholders give the guarantee to some amount. If company is collapse or company is bankrupt, then we will pay particular amount from our own money, from our own asset. That is company limited by guarantee, giving a guarantee. For example, say here shareholder will say, shareholder A say, once company closed, I will provide 100,000 from my personal pocket. Shareholder B will say, I will give 50,000 from my personal pocket. So once this company is closed, creditors are giving 250,000 worth of credit. Now when they giving the credit, they know that creditors know this company is limited by guarantee. So they will take the article of association or any documents which tell that is company is guarantee how many what is the amount that shareholders are guarantee for that. So creditors will satisfy, okay, even though companies become a bankruptcy, I can recover 1,50,000 from the shareholder. So balance 1 lakh recovered from the companies. This is how companies limited by guarantee works, right? Then I am going to explain what is meant by the quoted and unquoted companies. Please listen carefully, right? To explain this, I have to take the whole companies. For example, private limited companies, for example, if any business going to make a company form organization, they registered under the Companies Act, right? Registered under the Companies Act. When they registered under the Companies Act, shareholder may be one person or two person. Good example is two friends get together and open a company. Then that is private limited company. If the two friends wants public to invest in this company, so they will announce public that we have opened this company, please invest in this company. So that power will only comes if that company registered as the public limited companies. So how publics are invested to invest in this company? Only one way is available in Sri Lanka, that is Colombo Stock Exchange. Company should registered under Colombo Stock Exchange, that is located in World Trade Center in Colombo, right? If registered, company can post a prospectus. Prospectus means advertisement of inviting to invest in the shares, right? If company post a prospectus, Colombo Stock Exchange will advertise that prospectus in front of everyone in that Colombo Stock Exchange, that lobby. Then everyone will see, okay, this company is going to issue this number of shares at this price, so they will invest, right? So that is public limited liability companies. For private limited companies are companies registered under the Companies Act which are not allowed to issue the shares to the public. Public limited companies are companies which are registered under the Companies Act which are allowed to issue the shares to public, right? So public limited companies can issue the shares to public Quoted company means companies listed at Colombo Stock Exchange. So company can issue the shares to public through issue shares public through Colombo Stock Exchange. Anyone can go to the Colombo Stock Exchange and registered as the shareholder. Once the person registered as the shareholder, they have the power to purchase the shares of any companies. Right? For example, say this company is John Keel's. John Keel's one share price is say 250 rupees. So if person A registered in Colombo Stock Exchange as the shareholder, right? Person A also should register as the shareholder. John Keel's also registered in the Colombo Stock Exchange as the listed entity. Then they both are registered. Then person A can buy the shares, right? If John Keel issue the say 1,000 shares at 250 rupees. So person A can decide how many shares he want. Say 500 shares he want. So 250k. Then $1,25,000. 1,20,000 investment come to John Keel's. Capital from the public, right? Here unquoted companies can be collected the share capital from the companies, but not through the CSC. They use the private placement, right? So these are the doubts we have from the A-level studies, right? We know we have by heart at the what is meant by the private limited companies, what is meant by the quoted companies, what is meant by the unquoted companies, what is meant by the companies limited by guarantee, then what is meant by the unlimited company, but we do not know the meaning. See, in A-level studies, no teachers will guide you to understand the meaning. This is the meaning. Then you can create the definition in your own, right? So private public limited companies divided into two: quoted companies and unquoted companies. Unquoted companies shares are already listed in the Colombo Stock Exchange. Anyone can come and buy the shares, right? Any entity can sell their shares. But unquoted companies not listed, but they can issue the shares to the public. They use in the private placement. Issue shares to public. Private placement. Private placement means whenever the company need the money, right? Company wants to raise the money to the share capital. Say if company wants the money, there are two types of capital there. Capital can be infused by shareholders or lenders. Owners can infuse the money or bank loan can be taken. So bank loans are come under the lenders. Shareholders invested, that is called share capital. Share capital or equity capital. Normally we say equity capital. Equity capital is a very good technical name for shares investment. Capital invested by the owners. Lenders will provide the loan capital, right? Loan capital. Share capital and loan capital, right? Loan capital can be say debt capital. Very good name for this capital is debt capital. Very good technical name. Equity capital or debt capital. For example, good example for this unquoted companies, Agrabhatana Plantation. Agrabhatana Plantation. Agrabhatana Plantations Limited. Right? This company is unquoted public limited company. So this company wants to buy a plant. This company is a tea company, tea estate company. It has the more than 22 estates in Sri Lanka and harvesting the teas and changing the tea leaves to the tea powder and export to the foreign. So this company is involving in, right, manufacturing activity, agricultural activity as well as the manufacturing activity. Some that manufacturing activities will have the factory and equipment, plants. So say Agarapatan Plantation, one of the machines was broken, so they want to buy a new machine. New machine's price may be 100 million. See, so 100 million. How the shareholders going to invest? Say shareholders does not have the money. Shareholder wants to invest somehow this 100 million. Otherwise, this business will be stopped. Operation will be stopped. So therefore, they will find a solution. So through the private placement means, right? So there are a board of directors there, chairman there, CEO there, managing directors there, accountants there, finance manager there, sales manager there, marketing manager there, human resource manager there. So these people are called management. Management know the need of this company. Then management will decide to whom we can take this money. So management will sometime request one of the good businessman in the public. For example, see, the businessman name is Harry. This businessman name is Harry. He has the more money. Everyone knows that, right? This is assumption. So, right? This name also I have taken hypothetical name. Say this person Harry has the more money in his hand. So management, one of the management person sometimes know about this person. So that person can call to this person and ask for investing in this company. So Harry is not involving in business of Agrabatan Plantation, but he is from the public. So public, we choosing one person and advertising our shares. So we'll say we need the 100 million of cash for purchasing the plant. In future, we will definitely make a profit through this plant. Can you invest? If he is agree, he will invest. It will be formal procedure. There are agreements, there are share certificates, right? That is, we do not need here. We should understand how this going. Then he will invest. That is private placement. So it's a public, right? Money taken from the public. Otherwise, chairman's friends can be invest. Right? Anyone in the management can request outside party to invest. Right? If say chairman, one of the friends is a rich person, so chairman can request. Or if say accountant, one friend or one relative is a rich person, so accountant can request. This is how it works, right? So companies limited by guarantee also same thing, but it is registered as a companies limited by guarantee. It is not come under the private limited companies or public limited companies, right? Company limited by guarantee, at my knowledge, double 80 is the company limited by guarantee. Only one company available in Sri Lanka, I think, right? Then unlimited liability companies. Shareholders liability is not limited. According to this example I have explained, right? Here companies shareholders are safe, but according to Companies Act, unlimited company shareholders are not safe. If company become bankruptcy, the shareholders will have to settle the company's debt from their own assets and the cash. So I believe all of you understand. Let's see what are the advantages of the company. First advantage is, do I need to tell that? First advantage is, you know that. What is that? First one is company shareholders liability is limited. That is first advantage. That's why this company is formed. Actually, this company, that's organization which is called company, registers the company, is really advantage for the shareholders, investors. Investor invest, and if company bankruptcy, no need to pay for employees, no need to pay for creditors, no need to pay for bank loans, right? That risk is up to the investment they made. So first advantage is, I will write here, advantages of company. First one is limited. Please take this note. Limited liability means shareholders investment is limited, shareholders debt is limited. Sorry, shareholders invest is not limited, shareholders debt is limited, right? If company become a bankruptcy, shareholders are losing only their investment. They do not want to pay the company's debt from their own asset or own cash. First one. Second one is company can raise the money easy. Good example is here, public limited companies. Public limited company wants the money, they can issue the shares in Colombo Stock Exchange. If it is a quoted company, if it is an unquoted company, they can issue the shares to the public through the private placement. Private limited companies also issue the shares to the out party, but most of the time the private limited companies regulations are very low, very less. Therefore, out party do not like to invest in that private limited companies. That is the first reason. Then private limited companies also issue their shares, but not publicly, privately issue. For example, say this company's shareholder is person A. Person A wants the money, so he can sell his shares to his father or his wife. Then father or wife will invest in that company. So by issuing the shares to external party or within the shareholders we already have, we can raise the money, right? Therefore, raise the money through the capital, equity capital. Equity capital is good. Then raise the money, debt capital also high, because companies' financial statements are audited by the auditor. So auditor will give an opinion that is this financial statement is giving a true and fair view. Or auditor will give this financial statements do not give a true and fair view. So auditor, that is independent external party, give opinion on the financial statement of the company. So external lenders, that is debt capital provider, bank or finance companies, will see the audited financial statement, see the auditor's opinion. For auditor's opinion will tell company's financial statement is correct or not. Based on that, bank will provide the money, right? This is how the companies are improved business organization. Best organization to run a business in world is the company. Form a company and run a business, that business will have a more secured ways, right? Then fourth one is, I don't need, these are very easy, right? Fourth one is, companies are taken as a legal separate personality in the eyes of the legislation. Therefore, company can go for agreement in its own name. Then company can go for open a bank account in his own name. But in sole proprietorship or partnership, shareholders in bank account or agreement will be open in a proceed in a owner's name, not like a company. These are the advantages of the companies. In addition to this, we can take a tax rate. Company tax rates are fixed, whether that is 28% or 24% or 14%. So once the company in the 100,000, say one company's tax rate is 28%, according to Inland Revenue Act, the number 24 of 2017 Inland Revenue Act, Schedule 1. According to the Schedule 1, each and every company, there are categories. Based on the categories, tax rate of the companies will be decided. For example, say normal tax rate for companies is 28%, but tourism industry companies are 14%. Small and medium entities are 14%. There are many categories. Based on that, we will decide the tax rate, not based on the profit. Right? If 28%, even the company is 100,000, 28%. 28% on the 100,000 is tax. If company is a 100 million, then also 28%. But individual tax rate is not like that. Individual tax rate is like a block. First 600, first 600, first 3 million, 6%, right? Second 3 million, 8%. It's like that, right? Second 3 million, 8%. So it will be gradually increase based on the income, but company's tax rate is fixed. Third one is 1, 2, 3, 4, 5, 6. Seventh one is transfer of shares. These are additional advantage. Transfer of shares. When company wants to sell that company, that shareholders want to sell that companies to the another person, just sell the shares, and that own the purchaser of that share will be shareholder. Then very easy to transfer, giving the shareholder certificate to different person, and that different person will become shares. So transfer of shares will be very easy in the company. Then let's talk about disadvantage. First disadvantage in the company is compliance cost is very high. Compliance cost is very high. Each and every year, financial statements should be audited. Then audit fee is there. Second one is each and every year, annual return should be submitted to register of the company. That is also cost, right? Then secretary. If company is formed, there should be a different secretary firm or different secretary individual who should be hired for every company, right? Secretary fee is there. So compliance cost is the main thing, right? Then say we can take one by one this organization and find out the disadvantage. For example, take public limited companies. Public limited companies, that is quoted companies, following the CSC rules. So if they follow in the CSC rules, they have to comply with the CSC rules. CSC rules is they want to submit the public financial statements, publish the financial statement to public, right? It's not an easy task, right? Then then we can take a tax also. If we take a tax, right, tax we can take a advantage and a disadvantage, right? For example, if a sole proprietor, right, say income is 10,000, so their tax is 6%, say. When income increases only, tax rate will be increased. But company's tax rate is fixed. Even though income is 1 rupee, they should pay the tax 28% on that, right, or 14% on that. The tax rate will be decided based on the Schedule 1 in the Inland Revenue Act. These are the disadvantage. Then also we can take additional disadvantage, that is share issues, very regulated one. When shares issued, we have to inform many person. So we have to first pass the board resolution and get the approval from the secretary, then inform to the ROC, right? So share issue will be more regulated by the ROC. And also share capital also cannot be easily reduced, right? Based on the companies, we have to follow some procedures, that is we do not need here, right? Understand and keep this in your mind. This is enough. And very good, very important thing is, these financial statements are measured, are published to the shareholders only. No need to publish to employees, right? Shareholders wants the financial statements in order to see the performance of the company. That is must. Second one is, time to time, loan provider, any loan provider, bank or finance company can request the financial statement from the company. That is also we have to give. Not only the financial statements, cash flow statement, management report, budget, forecast, that is also sometime bank will request. Therefore companies are liable to provide the that requested reports. Third one is tax authority. I have already told, to see the performance, to comply with the tax authorities, and to comply with the bank loans. Sole proprietorship and partnership provide the financial statement, prepare the financial statement. So these three things very important, right, in the company. So financial statements are prepared for these three persons. First one is we want to see the performance. Therefore financial statements provided, which is that financial statement will be taken by whom? Shareholder invested money. They want to see whether this company is making a profit. Second one is comply with the tax authority. Tax authority definitely will request the financial statement from the company. So that tax authority is IR department, Inland Revenue Department. Third one is bank loan. Comply with tax authority, comply with bank and loan, or to see the performance of the company, we need to prepare the financial statement. So this is lenders. For these we definitely prepare the financial statements. But assume employees, if any employee, one of the employees, right, say new employee coming to join in our company. So when he requests the financial statement, we are not liable to provide to him. Who is he? Employee doesn't invest the money in this company, right? Employee doesn't invest in equity capital or debt capital, or employee will not collect the tax from us. Employee just give a employment to us and taking the salary. They are not required. That is not compulsory to provide the financial statement to the employee. That is very important. Then also according to that Sri Lanka financial reporting framework, we are preparing the financial statements, right? Very important thing is here. So this company's explanation is done. Now next topic I am going to explain you is the information we need to prepare the financial statement. So we are studying this to prepare the financial statement. This should be financially measured, right? Should be in a monetary terms, right? If financially measurement of the each transaction should be worthwhile, then only we should go for preparation of the financial statements. That is called economic of the information. Economic of the information. Right? Which is explained like this. The economic of the information studies the importance of information, how it affects the economy and economic decision. It was originally developed around the assumption of perfect information in the absence of the uncertainty. However, this was soon realized to be unrealistic, and as such it now integrates the possibility of imperfection information. In the real world, information is easy to obtain, but can it be trusted? Information is subject to manipulation, and this can be also be the case in financial reporting. One person might deem a purchase to be capital, whereas another may deem it to be revenue. If all of the other information in both companies is the same, then the company where the accountant decided to treat the item as revenue will always have lower profit than the company in which the accountant decided to treat it as a capital. The outcome of this decision will affect the view of the company and may affect users' decision. For example, potential shareholder may decide to invest in the company which has the higher profit. It says, for example, take company shareholder investing the money of 100 million. Then capital will be increased 100 million, right? If I take this as a balance sheet, right? Take balance sheet. So this side is asset side. This side is capital side. So liability side. Liability means capital and liability. If 100 million injection to this company, capital will increase by 100 million. Cash will increase by 100 million, right? With this cash, right, company can buy a inventory and the assets. For example, say company making a revenue, sales value is say 50 million, right? Cost of sale is say 25 million. So gross profit is 25 million, right? So overhead cost, in overhead cost, right, depreciation will be there. In this cash, company purchasing say building worth is 50 million. So company's asset is 50 million. If companies do not want to recognize the building as the expense, asset can be recognized as the expense. Then if building expense is 50 million, company making a loss of 25 million, right? This is the normal, buying the building and charge as the expense. But normal practice is based on the lifetime of the building, we charging the expense, portion of the expense in each and every year. For example, say company, this building can be used for 10 years. So depreciation, accumulated depreciation will be charged 5 million per annum, right? 10 years, 50 divided by 10, 5. So asset will be 45 million at the end of the year. So expense will be charged only 5 million. So company making a profit of 20 million. So in previously company made a profit of loss of 25 million. Currently it makes a profit of 20 million. Actually this cash is tied with this 50 million cash is tied with the building. Should be recovered over the life of the building. Base. So who decide the depreciation rates? Depreciation rates will be decided by the accountant. So based on the accountant decision, profit of the company will be made, right? He can decide this lifetime of the building maybe 20, right? He can decide 25, but it should be justified, clarified, right? If he decide and confirm, anyone will see and invest in this company by watching only the profit. So watching only the profit is not worthy. If you take the economic decision, cash flow, asset side also we have to look. That is what that paragraph explains. Economic of information. Information should be give a correct view of the company. Therefore, not only the profit or loss statement enough to take the economic decision. Understand first, right? That's why LKS1 emphasizes all the business to prepare the 5 financial statement. First one is statement of profit or loss. Second one is balance sheet, statement of financial position. Third one is statement of cash flows. Fourth one is statement of changes in equity. Fifth one is notes. In the notes, company will explain how their depreciation policy, how their bad debt policy, how their capital investment policy, right? So all 5 financial statements should be audited by the auditor in the companies. So these 5 financial statements will be assessed by the auditors. Auditor is qualified auditor. If financial statements assessed by the auditor is wrong, auditor will be sued by the that particular professional body. If chartered accountant is auditor, so that is he not giving the correct opinion on this financial statement, he can be sued. Chartered institute will give a commission on him and take a good action for him. That's why auditing job is very riskiest job, because audit opinion should be given on the truth. We cannot give a lie opinion, right? We cannot lie. We can give the false opinion, right? So this is enough to understand the why we need to prepare the financial statement, why businesses need to prepare the financial statement. Then how we have to prepare the financial statement only according to IFRS standards, International Federation standards. Only Sri Lanka accounting standards are produced from 2012 onwards. Sri Lanka is fully adapting the IFRS standard to the Sri Lanka, right? That is come under name is IAS, International Accounting Standard. Sri Lanka Accounting Standard, LKAS, Sri Lanka Accounting Standards. Now Sri Lanka Accounting Standards are fully based on the IAS, International Accounting Standard, after 2012. From 2000 to 2012, there are many scandals, many bankruptcy in the companies. Financial reporting are not properly prepared. There are many frauds found in Sri Lanka, many companies. So therefore, Chartered Institute decided to use the IAS for LKS, right? This is enough to go deeply to our subject. And another topic is there. I will do that topic next. That is governance. What is meant by those charged with governance? Very easiest topic. Within 10 minutes I can explain that. Okay friends, thank you and good luck.
Thank you for watching the video. Stay tuned with castudies.lk for more lectures online.